Hello, I'm Finola Burke from RaaS Research Group, and we're focusing today on spatial data and digital twin solution group, Pointerra, ASX ticker 3DP. Joining me to discuss Pointerra's FY25 results and outlook is CEO and co-founder, Ian Olson. Welcome back, Ian.
Hey, Finola. Great to see you. It's been a little while since we spoke, so
Indeed.
appreciate the opportunity.
So Pointerra delivered a 45% increase in revenue in FY25 and reduced operating profit by almost 3.4 million to a loss of 700,000, with a big focus on cost containment. Were you happy with the results, and can you maintain that cost containment going into FY26?
Yeah, first question: were we happy with the result? No, we weren't, because after the H1 result, where we generated we were EBITDA positive, and I guess a maiden reporting period earnings result. And with line of sight we had on contracts awarded and work in hand, we expected a lot of those to start and allow us to invoice. So not only recognise revenue, but also get cash receipts during Q3 and Q4. And obviously Q3 was a big disappointment. A lot better in Q4, but what that translated to was an underlying EBITDA result of not far the wrong side of break even, but probably from our perspective 3 to 4 million Aussie on the table that we would have expected to invoice. So it's work that will be invoiced in FY26. Not massively happy with the result. I guess 46% up on FY24 is in and of itself looks compelling, or looks attractive, but given what we were expecting around January, February, March time, a bit disappointing. In terms of cost containment, I think if you've looked at our operating cost line over the journey, we've been pretty careful about managing that. And so I think our internal budgets and for FY26 and what we're currently forecasting amongst ourselves inside the business, we're not seeing a material leap in costs, but we are hoping for a material leap in in top line revenue. So that should drop out, all things being equal. A nice EBITDA result for the year. But again, we're not in a position yet where we're able to have forecasts in the market, but we're certainly pretty excited about what FY26 will look like financially. But that's the numbers are a result of customer engagement. So growth with existing customers and growth with existing customers and new contract awards, and other onboarding opportunities, particularly in some of the tier one customers. So we're reasonably comfortable with how FY26 looks like shaping up, but clearly a miss on FY25.
You have alluded to the fact you have got a number of contracts moving into billable invoices in this half. How much visibility do you now have on H1 FY25 revenue and cash flow, Ian?
Yeah, good visibility, but I would have said that in February, March, Finola. So, there's some stuff's out of our control. As followers of our story have heard me talk about in the past, we can get contract award and program award, and yet our ability to invoice becomes a function of data availability from other contractors that our customers are engaging to go and capture. So that's going to remain a challenge for us on the bigger programs, not so much at the smaller end of town where the sorts of users in the survey mapping space and the digital engineering space, it's very much a more traditional SaaS model where it's seat based. They've already got their own data, or they're generating their own data for their own customers. And so we've seen across our sort of the two ends of our customer spectrum throughout FY25, we've seen great growth in the number of users at that sort of sub 50,000 US ARR. And we've added some really fantastic banners and brands to at the bigger end of town for those sort of 6 and 7 figure opportunities, and it's those ones where they're using our platform. It's a SaaS deployment, but they're using our platform in a programmatic manner when where they're sort of waiting for delivery of data from their other contractors. So, but as we look out into calendar 26 and beyond, our expectation is that the impact of those delays will be less and less as we get more diversity into the customer base, not just other banners in and other brands in, say, the US utility space, but also in other sectors, whether that's transport or mining or oil and gas.
I think you also alluded in your quarterly results recently about that you have onboarded a number of new enterprise customers across a number of these different sectors.
Yep.
Can you just expand upon that, particularly on the global mining and the oil and gas sectors?
Sure. Well, obviously, there are fewer tier one oil and gas and mining companies than there are, say, US energy utilities or global energy utilities that offer that same addressable market. And what we're pleased with is the progress we've made with particularly in the oil and gas and mining sector of some of those tier one brands, and our revenue stack and our customer adoption profile through FY25 is a material improvement in those sectors on FY24, albeit from a low base. And so by the end of FY26, we expect our revenue line to have a lot more diversity in it. And what does that mean? It means we're not so dependent on one particular sector, and we're not so dependent on one or two large customers in a particular sector. And those journeys pleasingly are all customer led. We've got deep engagement with a couple of mining companies and a couple of oil and gas companies where there's deep iterative engagement in terms of the deployment of Pointerra Core for them to store all their digital twin data, and then the development of analytics to try and automate some of the desktop and inefficient workflows they're experiencing with the way they've traditionally operated their business. So the theme's the same. We're a platform for people to construct and manage digital twin data, so 2D, 3D, IoT data across the enterprise. It's enterprise ready. It's corporate IT ready, and so there's a nice journey that we can go on with those customers to add more seats, to add more data, to add more analytics, which creates a nice pathway to grow their spend over time. And because it's a workflow solution, when customers go live with us and make a commitment, it becomes extremely sticky. So it starts to tick some of the boxes that I know the market looks for in terms of how is there churn, and what is the basis for you to grow the spend from a starting point to a greater number over time.
And strategic partnerships are highlighted as a key part of your growth platform too, Ian. Could you talk about the progress your partnerships with Emerson, AWS and Esri made in delivering prospects and revenue in the last 12 months?
I'd say mixed results. Finola, one of the advantages of a strategic partnership is broader distribution and more people out there telling your story. One of the weaknesses along with that is our inability to control the degree to which they're focusing on our solution compared to the other solutions they might represent, or indeed their own platform. So it's certainly interoperability in particular with the Esri platform, which is ubiquitous across almost every enterprise customer globally, is really important for us. And we've made a great start with Esri's new electric utility solution, and onboarding that for an energy utility requires a fair bit of prep work that Pointerra really we're in a sweet spot in terms of solving a bunch of onboarding problems. So we'd like to think we're going to help Esri grow their spend in that their customer acquisition in that space and the deployment of that solution. But I think of bigger more significance from a growth perspective is the impact of AI. And we've had AI in our analytics space and in our core platform for some time, but over the last 6 to 9 months, we've completely re-engineered and rebuilt our go-to-market strategy using tools and platforms that didn't exist even earlier this calendar year. What does that mean? It means we've got a smarter, more scalable, lower cost way of growing our sales pipeline, and not just growing the front end, but also one of the areas of focus is the what's called the mid pipeline, where colloquially a lot of deals can go to die. What does that mean? It means that you can identify a fantastic opportunity at the front end, But then to move that through from initial trial and early adoption into a 6 and 7 figure enterprise solution, the mid funnel is a place where we've made a lot of investment in methodology and indeed external platforms. And what does it mean? We expect that it'll mean that we can scale our business, scale our revenue line with even more constraint on the cost side. It should mean that we can do more with less humans in terms of onboarding customers and moving them quickly through that through the mid funnel and squashing up the time it takes. So yeah, it's fascinating having everyone's got an AI story, but what's been fascinating in the last 6 to 9 months is just how much of an impact the emergence of AI and the tools that really clever people are deploying, the agents that they're deploying on top of some of the more traditional LLM models that people would be aware of, the household names, the ChatGPTs, the Groks and others. And they're I guess they're kind of doing what we did a few years ago with our platform, is that they're taking really robust sales methodologies and baking them into an AI-enabled solution that's available as a SaaS platform to people like us. And because what's happening at the customer end, customer want to learn about you in the past. They'd perhaps go to your website. They'd perhaps put some keywords into Google. They might do some outreach, or perhaps call someone like Gartner and say, hey, what do you know about Pointerra? And what we know is happening now is that those prospects are doing an enormous amount of research themselves. So they're coming into any conversation having asked questions like, what is Pointerra? Who are its competitors? Why should I use it? What difference will it make to my business, etc.? So they've got more. I don't know if they've got more data or more information. I think the jury's out on whether it's information and insight or just more data. But what it means is you're having the initial conversations you're having with people, whether it's a $500 or $1,000 a month small business, or a $50,000 to $250,000 to $250,000 a month enterprise customer. The not just the operational people, but the corporate people, the project sponsors, the IT, the risk, the legal people. They all know an incredible amount more than they used to, and they can access that insight readily and at low cost. So it means that it puts more emphasis on the quality of your conversation, the ability to look through the noise of all that information and remind them what the value proposition actually is. Pay me $1 and I'll show you how I can save you $5 to $10 to $15. And it's the ability to generate that cut through in a compelling way that I think is going to separate B2B SaaS businesses that are sort of waddling around in the ether trying to figure out how to scale their business, versus those who access the right tools and re-engineer their go-to-market strategy in the right way, that it not only allows them to scale quickly, but do it at a cost that was perhaps unthinkable even a year ago. So it really has been. And so one of the advantages of being a business of our size, 30 odd people with less than a third of that at the front end that's customer facing, I'd like to think we've been able to be quite nimble and agile and entrepreneurial in terms of identifying the trends and adopting new solutions to try and make our go to market more efficient. And what's happening domestically in North America we've talked about structural tailwinds before, particularly around resilience investment in US energy utilities. But overlaying that in the last 6 to 12 months is this incredible race to put silicon into data centers all across the US. And what that means, apart from the silicon and fantastic businesses like NVIDIA, is bricks and mortar and steel and contractors and construction timelines that perhaps only Elon Musk and Tesla were doing, we're contemplating in the last sort of 5 years. So the amount of capital that's going into the ground in North America, it's quite phenomenal, and that has a flow-on effect and a multiplier effect for all the trades. So you think about surveying and mapping, you think about design, engineer, construct, all those customers and prospects of ours that are trying to support this incredible sort of generational investment in data center infrastructure in North America. They're all having to try and do more with less, and so they're increasingly, accelerating the pace at which they're willing to think about new workflows and new ways of doing what they've been doing for a long while. So again, it's kind of out of nowhere has this brand new sort of additional layer of tailwind for our North American operation. It's really it's incredible. It's largely invisible to a lot of Australians because the lens we have, whether it's through mainstream media or perhaps even the capital markets, I don't know that there's an awareness of just how much money's going into the ground in that country, and that's in data centers. That's before we talk about energy dependency and oil and gas and the mining. You saw Simon Trott and the Rio and BHP leadership team in Trump's office the other day. I mean, when did that happen? So in the last 20 years, when were two Australian mining companies of that scale in the Oval Office? So I can't overemphasize just how big an opportunity for businesses like ours that are entrenched. We've been in the US since 2018. What the next 2 to 3 to 4 years looks like if we get it right. So I probably banged on a bit there. So
no, that's all right, because it leads nicely into.
To
my last question, which is actually also very pertinent. But you ended 2025 with $1.8 million in cash. Obviously, there's opportunities in the US. Do you feel you have sufficient resources to grow the business without returning to the capital markets?
Yeah, we certainly do, Finola. I think there's it'd always be good to from the market's perspective to not become raised, and you have a crap quarter or you have a crap quarter and a not so crap quarter, and people look at the numbers and they look at the 4C and go, well, gee, there's not runway, so hey, maybe they're coming raise, and then your share price reacts accordingly. I think as we noted in the March and then the June quarterly, in both, we talked about having in excess of Australian $4 million worth of work in hand that was contracted and awarded, and uncollected receivables. So that gives us, if you think about what that looks like from quarter to quarter versus our cost base, which is kind of around the $2.5 to $3 million a quarter. We're pretty confident about the need to not have to come back to the market for working capital purposes, and trying to maintain our theme over our journey of growing our business through customer, and being customer led and revenue generated from our customers, as distinct from having to come back to the market every 6 to 12 months to raise growth capital. Interestingly though, the prize is still top line revenue growth. The prize is still ARR. But at the moment, there's clearly a big test particularly in our capital market is, well, can you actually sustain your operation? Can you sustain your business? Because if there's too much of a chasm between where you are now and what operational leverage looks like, and the implications, you're going to need to raise a lot of money from the markets, and obviously they're not that risk on at the moment and haven't been for some time. So it's very much front of mind. But at this point in time, I think we're quite comfortable with where we are.
Well, thank you, Ian, for taking the time to discuss Pointerra's FY25 results with me today. I'm looking forward to catching up with you over the course of the next 12 months to check on your progress.
Fantastic, Finola. Thanks for your time.